built on a foundation of trust, excellence, and integrity. As one of the oldest stockbroking firms, we have navigated challenging market landscapes, consistently delivering values to investors. Today, we proudly carry forward this legacy as we magnify our portfolio management services, a move that aligns with our commitment to providing sophisticated, research-driven investment solutions. We are pleased to share that our PMS offering has already garnered an AUM of 100 crore under a very short span of 7 months, reflecting the confidence investors have placed in our expertise. But this is just the tip of the iceberg in our journey of growth and wealth creation. To give you the deeper insights into our investment philosophy, fund offerings, and what sets Paterson apart in this PMS space, I'm delighted to introduce you to our distinguished fund managers, Mr. Prasanna, Bidkar and Mr. Sagar, Lele. They'll walk you through the details of our fund, our approach to wealth creation, and how we aim to deliver consistent and sustainable returns. So following each fund manager's presentation, we'll take a few minutes for a quick Q&A. So please do hold on to your thoughts and questions in the meanwhile. So once again, thank you all for being here. So now over to my colleague, Ms. Purnima.
Thank you, Darshini. Good evening, everyone, and a very warm welcome to all of you. Today's interactive session is with the Paterson PMS team, and the theme for this evening is stories. Yes, stories. Kadai, kahani. Powerful stories are just simple facts wrapped in emotions and imagination to create timeless magic. The story of Paterson is itself very intriguing. A company started by an affable Englishman called R.C. Paterson in late 1800s. The firm has over 100 years of history, whose numerous chapters correspond with the evolving face of Indian industry and commerce and the Indian equity markets itself. Paterson is an institution whose contribution to South Indian, especially Tamil Nadu-based industries, is well documented and revered. As underwriters, Paterson has helped many great companies like Sundaram, Rane, Madras Cements, MRF, Ashok Lele, etc. to begin their illustrious journey as listed entities. Our story has had many villains as well down the ages. Natural disasters, 2 pandemics, a tsunami, and the several financial scams that shook the foundation of the stock market and the faith of millions of investors. But Paterson stands rock solid. The protagonist wins always. It shows that some storylines never go out of style. So what has Paterson's story actually been about? Our unassuming presence, our deep focus on client interests, an uncompromising emphasis on fundamental equity research, and an unshakable belief that wealth creation comes with patience and endurance. It's a simple story, but impactful though. An interesting question came up when I was calling people to invite them for this event. Mr. Sathyanarayanan of Purple Pond, he's not here unfortunately. He asked me, why are you having this event? What is the purpose of reaching out to people in the same industry? My reply is this. All these decades, Paterson has quietly been going about its business, diligently servicing clients and giving them excellent stock recommendations. This is validated by the fact that we have serviced several generations of clients. Foreign institutions since the time they tentatively took their steps into India, domestic institutions, corporates, the entire range. In fact, we have been the most sought after as trustworthy and sensible partners to help build solid equity portfolios. We have banked on fundamental research and a deep insight and understanding of how managements work, which we feel is more important than just ROI or P ratios and things like that. As for our PMS, we have been active since 2004, but in a very low-key manner. Today, as we interact with you, we want to share our story, because Paterson is not just historically significant, we are contemporarily relevant. I will pick up the thread of this current scene of our story from mid-2024, when the PMS team launched 3 strategies: Paterson Delta, Paterson Advantage, and Paterson Leadership Funds. And within about 7 months, we are nearing a corpus of 100 crores. Even as we we are adding to our corpus, the markets are on a downward spiral. How is the Paterson scriptwriter going to manage this? Let's get it from Prasanna, Bidkar, the CIO and fund manager of Paterson Delta Fund. Rashmi will introduce us.
So a few words about Mr. Prasanna. So he's a highly experienced investment professional with over 20 years of experience in the industry. So Prasanna has held key roles including head of research at Dalal Street Investment Journal and has managed equity portfolios of for HNIs. So he also manages successful value migration, small case and delta fund, both showing spectacular returns. So today Mr. Prasanna will share his insights on the current market conditions and outlook for India's economy in the upcoming years, and his personal perception on how India is positioned for growth in the coming years and what it means for investors moving forward.
Thank you, Darshan. Good evening, everyone. We gave a good introduction of mine, but yes, everyone wants to know about markets, not me. So, thing is, last few months have been very difficult for whether it is mid cap, small cap, or large cap, and we started our funds in those difficult times only. And despite being on the downward spiral, we have managed to garner a good kind of area in which we have managed in the 6 to 7 months. So every time I have been meeting with people, I get one query: what about markets? Where we are ready? One answer I usually give, like, where is the index moving? The most futile exercise we do is like predicting where index is going. Okay, so most futile exercise, but still people run behind those indices, try to make judgments. They may sometimes comes true, sometimes that doesn't come according to our expectations. But then amid all this, one single factor that remains is India is a growth story. We have to believe in India as a growth story. And there are larger opportunities which are coming to our way, and this is the right time to be in Indian markets. There are going to be some intermediates, downfalls, there are going to be good opportunities that emerge from this. So let's have a look at what our view is. Look, I am not going to give you some magic band or something that I will give you exact figures on, but there are certain data points which we want to indicate exactly where we are heading. So we'll just okay, so again, as I mentioned that we are one of the fastest growing economy. Okay, now everyone says, okay, we have been hearing that a lot of times, but then one advantage is 140 crore population growing at a good pace of more than 6%, 7% constantly, and that kind of what we can say compounding happening gives us an edge over developed nations and emerging nations as well. So we are still the fastest growing economy, and according to the data what suggests, we are going to stay in that bracket for a longer time. Okay, now we are the fifth largest economy right now, and very soon, if the way we are going to outpace Japan and will be the fourth largest economy very soon. So just imagine the kind of growth we are witnessing. We are in the right place and right place to invest. Okay? Many times, I have been in market for 20 years, and whenever I used to get some access to fund managers, more experienced people, whenever market was down, I used to ask them, okay, what next? What we should do? Well, they were always saying, you are lucky to be born in India because we are the growth story. And that stays from last 20 years, seeing ups and downs, so always been helpful. So next. Yeah. Okay, what are the advantages we have? Okay, one is population. People usually ask what the demographics have to do with growth and all. But then the kind of spending that happens and the kind of wealth generation happens with the younger population, the spending. So that shows where we exactly are. Okay. So 51% are under 30. So that shows us the economic. You know, there are certain countries where population has been declining, like Japan, China. There are now they are facing issues, and India is one story where we have a growth story. Okay, so that is one part. Okay, political stability. What happens is one important factor whenever I invest in any company, any country, is the political stability. It's been 10 years we are with the same government. They have been guiding us towards proper way where fiscal consolidation is also taken care of. I will come to that one in the next slide as well. Apart from that, a lot of infrastructure spending is happening. So that is, look what happens when infrastructure spending happens. It has a capital gearing of 1:10. Any 1 rupee invested in infrastructure gives me 10 times of opportunities that are available. So that shows what kind of growth we are having. Okay. Again, most important factor is the borrowing. So borrowing keeps a lot of pressure on our interest rates. Okay? I will not go into much into details of how interest rate affects us, and everyone knows that. But the kind of borrowing that has started to decline, and government is focusing on fiscal consolidation, that keeps an edge over other countries. Apart from that, if we look at the per capita income, we have seen a kind of growth. Okay, so that is another advantage which gives me an edge over others in terms of discretionary spending. Apart from that, India becomes a good consumption, domestic consumption story. We are not dependent on other countries. There are few sectors where we are dependent on other countries for exports and all. I will come to that slide also, but that dependency is declining, and that is a good part. Okay, so next. Okay, why India? Everyone asks me why India. There are other opportunities, there are other growth countries showing growth, but then the kind of depth with market caps in all the sectors. Look, there are countries where growth is there, but the kind of sectors we have, more than 15 good sectors having good market capitalization where large funds can be parked and easily liquidated. Okay, so that one benefit only lies with India. The kind of so we are the democracy where good government, stability, as I mentioned. So all these parts are making an impact felt on investment patterns. Okay, so a lot of foreign capital is okay. I will come to that FI selling also, why they are selling and all. But right now we are the country where proper investment is happening and returns generation is also happening. Okay, then we come to the household which invest in equity. I still remember when I was just having a discussion with someone that the ease of account opening, as you all know, how easy it has become. From just 3-4 crore demat accounts, now we are 21 crore demat accounts. With ease of that, technology changing, so number of people investing in equities has rapidly increased. AUM of AMCs, mutual funds, which was like 10 lakh to 12 lakh crores a decade back, now it's more than 60 lakh crores. That shows the kind of growth India is witnessing. The number of SIPs we have on regular basis, that shows that awareness is increasing. I still remember when I came to Chennai some 14 years back, I had an event at Vanimal, and the kind of queries I was asked for, like, sir, what to do with rental signing, what to do with some small 10 paisa company and all. But now the queries have changed. They know what the story is, where the money is. They know SIP is the way to get richer and wealthier. So that awareness has increased, and I guess that has helped a lot in terms of valuation that has happened for the investors. Okay, India's weight. Now, why I am focusing on this MSCI index is that shows how much weight we have in MSCI and how much more money is coming from that weight to Indian, and that showcases our power. Look at the way we have steadily increased. China has declined, but we have increased. That clearly gives an idea that the next growth engine is going to be India, and that's where the money lies. Yeah, next. now we have spoken a lot of good things, but there are few things that are not going right. Okay, first is that GDP annual growth rate. Last 3-4 quarters we have only seen decline, but then we have a higher base. There were a few things like election kind of thing happening. There were few state elections that happened, and apart from that, despite this decline, we are still the fastest growing economy. That one factor still stands. So this is one factor which is impacting us. Then another thing which actually guides markets is the earnings. If we look at the current scenario, what we are seeing, look at that how Nifty 50 revenues have come down over the past few quarters. Now we feel that the decline which has started around last 3 quarters is almost captured, and now here on EPS growth is expected to improve. So that will be some either higher single digit growth or a double digit growth what we are expecting. What leads to that? Okay, so as I mentioned, infrastructure and capex is one part which plays a lot of role in creating opportunities here. And the kind of capex we are doing and the growth rate we have seen, marginally there was some decline in the budget, but that gives me a cushion because government is staying within their means. They are spending within their means, but still the capex story on absolute terms has not changed. So that gives me an edge again. So though it's a negative factor, I still believe that capex still going on is a positive factor. Last main villain has been FII selling. Last 5 years, if you look at, we have seen huge selling. Rather, I will give a number. Since the last 1 decade, FII holding is at lowest right now, and DII holding is at the highest. There are no much changes in promoter holdings and all. So when this is going to stop? Look, there are 3-4 factors which actually determine that, but I will focus on only 2 factors. One is INR, which is very volatile right now, but we expect a lot of stability that comes. Look, we speak to industrial, most of the people from India, and they say it is not the fall in the depreciation in rupee, it is the volatility that kills us. So that volatility is going to stop, and once that stops, and again political stability and earnings. Look, we are slaves to earnings. Everyone is a slave to earnings. As earnings improve, we are expecting, yes, the FIIs are going to come back to India. As I mentioned, it's an investment destination with everyone likes with the kind of length, breadth and depth we have. Okay. Next one. Okay, so what we actually next. Okay, this is one thing which even I like is like as I mentioned, capital outlays have consistently increased. Okay, so tax revenue often has declined. So that is what we feel that, as I mentioned, every budget they have been saying means, and this rupee one invested is creating an opportunity which is like 10 times. So just imagine what next 5 to 6 years we are going to see kind of growth. So that is sustainable. Look, what we everyone says, yes, China is one market which is looking cheaper. There are other markets which are looking cheaper, but then we need to look at the quality and certainty of earnings. These are the 2 factors we always look at. So that premium what we are paying that premium for the certainty what we see in India. Okay, and I will give one not as a rule, but there is some kind of rule we have. Whenever economy which moves from 3 trillion to 5 trillion, what we are moving, there are hardly any major declines of more than 20% PC. Globally, you can check which economy moved from 3 trillion to 5 trillion and how much bearish phases they had. So that one data we need to check. One major villain which usually impacts our earnings is the inflation. But you can look at each and every country, there has been a decline in terms of inflation, and India also has witnessed a lot of decline and contraction in inflation. Okay, so that's the next part. Another thing is GDP growth, as I mentioned. So we are still at look at the placement India has. higher on the part of P ratio and even GDP growth ratio. So naturally there is going to be premium which is paid to such economies, and we are enjoying that. And yes, people are asking a lot of questions about what happens if Trump is imposing tariffs and all. So this is the one slide which I guess we must look at. So we are heavily dependent on two things. One is IT, which is the services kind of exports, and another is pharma. So those only two sectors are there which contribute around 50% and 23% of what exactly exports. Other sectors is less than 5%. So there is not going to be major impact even if tariff war starts and what exactly everyone is taking it as a negative. So I feel this slide gives an advantage that all sectors, there are many sectors where good companies are available at right valuation because of the current decline. So this one I guess gives a lot of comfort to us while we choose any sector for investing. Okay, another verification opportunity as I mentioned, kind of returns we have. Usually what we do is like if my GDP is growing at 7%, consider it 2.5 times or 3 times is what kind of returns I am trying to generate. And we have created CAGR returns of 21%, that Nifty 500 EPS and Nifty 500 returns at 20%. So thing is that shows that EPS growth has been larger and returns are less. Now I will give you one example. Whenever we are moving upwards, so there is one part that EPS growth plays and another part is the PE expansion. So what happens, 25% of my growth is from EPS growth and 75% the PE expansion. The PE expansion has come down a lot in last 6 to 7 months, and I guess that PE expansion as EPS growth also increases and the PE expansion starts, we are in a very sweet spot. Usually what happens, a lot of volatility either happens at the top or at the bottom. So the kind of volatility we are facing now, we know definitely it's not the top. We are at such phase where the bottom formation has started and we need to be very cautious. But yes, as I mentioned at the first stage only, predicting any index or predicting where Nifty will go, Sensex will go, Bank will go or Bank Nifty will go, so futile exercise. Right now we are into a scenario where it will be a very stock specific market and creating returns will not be based on those index movements and all. It will be very stock specific and we have to be very cautious where the opportunity lies. So apart from that, yes, as I mentioned, this Indian GDP CAGR, what we are expecting is like 29. The expectations are very high, around 10% CAGR, and you just multiply it by 2.5 times or 3 times. That gives an idea what kind of returns I am expecting from a market, which gives me a visibility. So certainty and visibility, those two factors I have, and that's why I am paying that extra premium over other countries. Okay, so I will just finish this off on one thing. As I mentioned, it's going to be a stock selection kind of market where everyone needs to be cautious. There are only 4 or 5 pointers we need to look at when we select any counter. Okay, so the first thing that comes to our mind is when we try to create a portfolio is size of the opportunity. Look, when I look at size of that opportunity in sector, I am not looking at the size, what size it is now or what size it was 10 years back. I need to look at the opportunity which will be 10 years from now. And here we need to understand it's not about the size of fish, it's the size of pond we need to look at. So as the pond size increases, even the fish size increases. That is what. Secondly comes in the growth rate. So when I am speaking about growth rate, it should be consistent and certain, as I mentioned earlier also. So if I am looking at some 40% growing CAGR company for last 2 years, I will prefer a 15 to 20% company CAGR company which has a certainty to grow. Okay, that is second part. Third comes the management. the quality of management. It is not quantitative, and it comes with the experience what we have speaking to management, what exactly they have delivered over the years. So quality of management. Look, capital allocation is a very important part that plays into business, and a good quality management, taking that size of opportunity, being the first one to grab that opportunity, you will be rewarded. So that is third part. Apart from that, the quality of business. Not every business is going to make money. We have to invest in businesses which are good, which are consistent, and apart from that, relevant. So that is the fourth part. And end of that, most important part, rather 40% of part, what after these four factors is the value I pay for that. So if I am paying excessively for that counter, I am not rewarded. We have to pick that value and then only buy at the right price. So these are the few factors what we actually find good companies to put on our portfolio. So I just thank you for listening to me patience, and I will hand it over to Darshini.
Thank you so much, Mr. Prasanna, for those valuable insights. It's clear that India's economic future is filled with potential, and your perspective on market condition gives us a lot to think about as we look ahead. So we're now open for questions. If there's anything on your mind, would you like to share it? I shall pass the mic. Anyone? So I guess we'll move forward to the next speaker. So about our next speaker, Mr. Sagar. It's my pleasure to introduce Sagar, an experienced professional with over a decade in the equity markets. Sagar has worked across many investment advisory, institutional brokering, and asset management, with his most recent role in fund management at Daiwa Asset Management, Japan's second largest AMC. He's also held positions at Motilal Oswal Securities, Antique Stock Broking, and the Wall Street Investment Journal. So over to you, Mr. Sagar.
Thank you. Audible? So I'll just start with where Prasanna ended in terms of saying that so the last 3 years have been a bull run, unprecedented bull run for the Indian markets. Anything that anybody touched or invested in has necessarily done well. For many, it was beginner's luck. A lot of new investors joined in after the pandemic, made crazy amounts of money, gained a lot of self-confidence in that process, developed a sense of intelligence that got tested in the last 3 months. And this is a good testing time not only for those investors but also for fund managers who got a little spoiled in the last 3 months. Our jobs became easier. Whatever we touched turned into gold. Creating alpha was very easy suddenly. It wasn't very difficult to find. Actually, it became difficult to lose money. So the last 3 years have been great for all our careers, but now times are changing. What we feel is that India's valuation re-rating that has happened over the last 3 years is something which cannot repeat in the future again. It will all depend on earnings. It will depend on how companies perform individually. It will depend on how good your stock selection is. It will depend on what kind of businesses you pick up and invest in for the long term. So our view is that from now on, it's going to be a stock picker's market. We have to be extremely careful in terms of what we are picking, what we are investing in. The time of easy money is pretty much diminishing. And with that, there is usually a very confusing start point for any investor, new or seasoned. The usual question is, where do I put money? Which mutual fund, which stock? And there's no easy answer to that. And the start point is usually pretty messy. Some people will open screener.com, try to figure something out. Some people open an app and put some filters in. Some people look at CNBC, look at the management and start investing. Others just take a tip from their friends. So to simplify the process, we've developed a very simple framework which depends on stories. And this comes from my time as a sell-side analyst in Motilal Oswal. My primary job was to recommend stocks to institutional investors. I was in the institutional broking team. So fund managers typically, what do you do with your portfolio, what to buy, what to sell. So I typically recommend stocks to fund managers and also give them liquidity for that stock. So the moment you initiate coverage on a company, I would call a fund manager to pitch that stock to them. The first question that would be asked would be story kya hai? And I've slightly tried to regionalize this. Story kya hai used to be the first question, and that was a good start point. As a sell-side analyst, half your job is analysis, half your job is selling. So we learned to build narratives, we learned to look at stocks from the perspective of the stock being a hero. And what is the stock's journey? What is the company's journey? And at the end of the day, is the hero going to win or is the hero going to lose? And if he's going to win, is he going to win big or is he going to win little? And you, at the end of the day, as an investor, will make money if you back the right kind of hero and solving the right kind of problem and coming up with the right kind of a solution. So that's what our framework is about. This is what we are trying to inculcate within the team itself. We've got a team of about 4 fund managers today. While all of them have different styles, they have different experiences, they come from different backgrounds, all of them follow the same framework these days. The start point is always what is the story. Even the analysts we're hiring, we're grooming them in this manner. Even the communication with clients becomes easy when we start with the story. So for the benefit of everybody here, I try to not keep this theoretical. I will include an example for what I'm trying to portray as a framework so that it's relatable. And as an example, I will pick up a stock which I made 10x returns on while at Laiva Asset Management. So I also include some posting and tap my own back here. Coming to a typical storyboard. A story has a character, he has a problem to solve, he comes up with a plan, he puts the plan into action, and then there is an outcome. If he comes out successful from this, that person is called the hero, otherwise he's a failure. So what we try to do while analyzing companies and investing is try to find heroes. We want heroes and we want those heroes to make us money. And heroes who do that repeatedly are what we now know as blue chips. You want a hero to solve problems consistently, keep solving bigger problems, keep taking bigger challenges up, keep solving those problems and make investors a lot of money on the way. So we like to pick up both. We like to pick up blue chips for stability because there is proven capability that a company exhibits there. We also like to identify companies here at the character level because this is where the confidence in that company is at its lowest. There is no proven capability, there is no proven credibility, but if you gain an insight into that company at this point in time, at the very first stage, the amount of money you can make is multiple times of what you'll make at the end of that spectrum. So multi-baggers are created here, long-term wealth is created there. Ideally, you want to write this entire journey and keep repeating it over and over again. And that's what we try to do at our PMS as well, where all the stock picking is done from a long-term perspective. We look at 5 years, we look at 10 years, we look at companies that have done this, they've been there, done that, and can't do it all over again. So that's our approach here. In terms of stories, we have a checklist. We don't like every story. Right? We want to, at the end of it, convert this into a wealth creation story for ourselves as well. We just don't want to be spectators in this. We want to make money. That's the end objective. So there is a certain checklist we've put in place in terms of ensuring that the story is legitimate, the story is predictable, the story has a foreseeable outcome, the story is actually producing or creating value. The story cannot have a battle which ends up in losses for both the parties or all the parties involved. That is value destruction. So we like value creation stories, not value destruction stories. And at the end of it, obviously, we also want to keep the story in check. There are checks and balances to ensure that are we on the right track? Is the company on the right track? Do we need to change our strategy? And this pretty much determines whether we need to double down on the story. Do we need to cut our losses? Do we need to trim our position? Or do we need to just hold off? So I'll move to the next one, where the most common three stories are these. There's an expansion story, there's a disruption story, and there's a turnaround story. Turnarounds are the sexiest, if I may. They attract a lot of eyeballs, they attract a lot of glamour, because that's the story where something impossible has actually turned around and created as a success story. But these are the hardest to find. Most money to be made, hardest to be found. The most relevant story, at least in the Indian context, is expansion and disruption. These are the most commonly found stories in the Indian market at this point in time. Expansion, because India is a growing country. Absolutely anything that you invest in, you'll hear a very common investment thesis: under penetration. Everything, whether it is underwear, whether it is sunglasses, whether it is jewelry, whether it is number of demat accounts, expansion, under penetration is a very commonly grabbed story. Disruption, again, I think we're at a day and age where a lot is getting disrupted, especially on the tech side. So a lot of exciting stories emerging on the disruption side as well. Turnaround is very hard to find. So probably I'll just give you one example and briefly talk about some of the stories that we picked up on the way. That's the mosquitoes getting big. So on the expansion front, there is one example I want to highlight is a stock that is part of our PMS strategy called leadership. This stock is called PG Electroplast. Now, while the PMS has been running for the last 7 months, the same team has also been running small cases. In the small cases, we had invested in PG Electroplast at a price of 40 rupees in October 2021. Price today is about 780 to 800 bucks. So we've made a crazy 20x return on this, plainly by identifying the story. What did we do here? PG Electroplast is a company which is started by a man who used to build basic electronic materials back in the 80s. What he started doing later is, the room air conditioners. They have a plastic shell, the outer coating. PG Electroplast was a maker of the outer coating. Now, because the founder had an experience in making radio transmitters, fixing up electronics and stuff like that, he naturally expanded into making the electronic components of the AC as well. So he had clients like LG, Samsung, Haier, etc., who they were selling shells to, AC shells. Now that they developed this capability, they went back to the customer and said, hey, I want to build you the entire AC, not just the shell. Suddenly there is a market or addressable market expansion of at least 20x with the same customers. We picked up the company when they started developing the entire unit of the AC and selling it. Now that itself got us from a price of 40 to about say roughly 400. At 400 bucks, the company takes another step. They say that we're not only going to now produce ACs, but we are going to replicate the same story for washing machines, televisions, and refrigerators as well. Now, most of PG Electroplast customers, nobody makes a single product. These consumer electronic companies make multiple products, so they're able to address needs of the same customers in a much bigger way now. So from 800 bucks, do we see this as a multi-bagger from here as well? Maybe not 20x. But still, over the next 10 years, I think this company will do a great job in terms of expanding their footprint, expanding their product portfolio, grabbing a more critical share of their clients. And as we know, companies like LG, Samsung, etc., they're good at the R&D, they're good at the branding. The manufacturing is always outsourced. So if you look at Dixon's story, that is a very popular one, multi-bagger historically. I think this is a Dixon in the making. So that is one stock we are heavily backing as an expansion story. The disruption story, commonly I think people associate disruption with tech disruption. It has to be brick and mortar to tech. However, I'll tell you about one story that we've picked up, not anymore, we've not invested in that story anymore, but it's the story, it's a very interesting one because you don't expect that kind of disruption. It is of a company called Shree Cement. So the market was dominated by Ultratech, Ambuja, ACC, and Dalmia Bharat. Right? Shree Cement was nowhere. Now what did Shree Cement do? The entire market was focusing on branded cement. Shree Cement came into the picture and said, to hell with branded cement. We are going to make commoditized cement and sell it in bulk. We are not chasing retail markets, we will sell to the government in bulk. We are not going to do branding, we are not going to do marketing. Branded cement sells at a 20% premium to bulk cement. They said, let's do that. Now, how does a company gain share in this? By cutting prices. When does a company cut prices? By reducing cost in a commodity. So, Shree Cement's disruption of the entire market was on the cost cutting front. So, what they did was very innovative things. Now, to make cement, you require temperatures of 1500 degrees to 1600 degrees Celsius. That requires a lot of heat. Constant burning of coal is required to keep the kiln temperature that high. You can't shut the kiln because once you shut it, to restart it, it's again a day, 2 day, 3 day process. In that process, whatever material is inside gets spoiled and has to be disposed of. Impossible task. Anyway, so power and fuel cost is the single largest cost for a cement company. Shree Cement, what they did was, they started putting in waste heat recovery systems. So the 1500, 1600 degrees Celsius that your temperatures are reaching, these guys put in technology to capture that excess heat, put it back into the system so that less power is required to keep the temperatures high. Shree Cement was the first one to achieve 100% WHRS in all their plants. Today, all the cement companies are there. Pioneer Shree Cement. Second thing, coal was getting very expensive. Coal as a commodity has been extremely volatile at a global level, very expensive. They were the first ones to introduce pet coke enabled plants. Pet coke, cheaper alternative, they started importing pet coke, turned out to be cheaper than even domestically produced coal, and that reduced their cost. Third thing, they separated their grinding and clinker and grinding units. Earlier, cement plants used to be integrated. Wherever the clinker is made, clinker are the small pellets. Those pellets you grind further and then make powdered cement. What they did was they put up a clinker plant and the grinding plant close to customers, so that they used a hub and spoke model, made their entire system more efficient. Then they introduced railways as a transport mechanism versus roads. That further reduced their cost. Overall, all these tech innovations were replicated by every single cement player out there. And we were at a point when they weren't replicated, that despite producing bulk cement, which is 20% cheaper than branded cement, Shree Cement's EBITDA margins were actually higher than all the other players selling branded cement. With that strategy, Shree Cement went from nothing and a new player to becoming the third largest cement player in India in a span of about 15 years. Every 6 years, this company has doubled its capacity and continues doing so. Obviously, now the story is over. Everybody has caught up, everybody has understood their game, everybody is doing the same things, so that story is over, so we're not playing that anymore. Turnaround, I'll not spend too much time on it, but a very famous example and from the south of India is Tube Investments acquiring CG Power. I think most of us are familiar with the kind of turnaround that was. CG Power was extremely marred in terms of corporate governance issues, fraudulent activities. It got sold to CG Power at a massive discount. They took a haircut on the debt, paid up debt upfront, and they turned it around within a span of 2 years. That stock has made, it's been a multi-bagger, but obviously those kind of stories are very hard to get. So to find distress and back that, we think it's easier to just play the first two stories in this market. And that's what we're currently focusing on. Obviously, if there is a turnaround story that we see, we'd be happy to invest in it because of the kind of returns. But the focus is the first two. So at the end of it, any story, what are you expecting? You are expecting the price to multiply over a period of time. Price, to be very simply put, is a function of EPS, which is earnings per share, multiplied by price to earnings, which is the valuation you pay. If you have one of those things in your favor, you make X amount of money. If you have both of these things in your favor, because they are multiplied, it is a non-linear outcome for you. So you make disproportionate returns if you are in any stock playing both earnings growth as well as valuation relating, which is why we developed a framework based on the story, but that's not the end point, that is only the start point. The next step is looking at what impact the story has on the stock's earnings. If the numbers are not supportive of the story, then the story gets scrapped right there. At the end of it, the story has to turn into good earnings, it has to translate into good cash flows, and it has to benefit the P&L and the cash flow statement, and then in turn beef up the balance sheet. And all of this is again pointless if the stock is not available at the right price. So if I'm going to get an apartment in some tier 2 city in India at the price of New York, I am not buying it. I need to make sure that I'm paying a good price for the story. Otherwise, the story will play out, but I'll not make money because the valuation is too high. So if I've overpaid for something, even if the story plays out as I want, I'm not going to make money because the market has realized it's an overpay and they reduce the valuation. And the last thing we look at is a trigger. So everything might be in place. S looks good, E looks good, B looks good. But if there is no trigger in the stock for the next 2 years, I'm lying on a dud investment. I'm here not to protect my capital. I'm not here to preserve my capital. I'm here to create long-term wealth. So every single story requires a trigger. And India is a market where there are so many stories playing out there that if I am currently in a story which is not making money, it is a very large opportunity cost. So from a fund management perspective, I want stories which have immediate triggers, and if not immediate triggers, at least visible triggers for this entire wealth creation story to play out. Now, there are certain things we try to keep in place just to make sure that we are selecting the right kind of stories. One is corporate governance. I think the long history of Paterson and a lot of South Indian companies, how they operate is they focus on sustenance. You'll see a lot of companies being passed on from generation to generation. There is succession which is very successful in South India. Usually you'll figure that a lot of the North Indian companies are tied up in feuds, family battles, unsettled companies, splits in companies. Now, this boils down to something which is very typical of South-based companies, and that's why we are also launching a flagship product called the Southern Spice. But corporate governance is something as a group that we highly value and that we highly stick with. At the end of it, you don't want to stick around with an investment which will make you money, but which will lose your sleep as well. So if it's a not good corporate governance story, then there is always a very high risk of intervention from the government, authorities, scrutiny, etc. If you're not making money, if you're making money by losing sleep, that's probably not worth it. Secondly, we want to play in blue oceans. We don't want red oceans at all. The current quick commerce space is a very good example of how this is going. Everybody's sort of killing each other, everybody's pumping in money, everybody's burning money, nobody's making money. Why do I invest in such a business? I'll just stay out of it, let them fight the war, let players die, let them consolidate. Once the dust settles is when I'll step in. So we want blue oceans, we do not want red oceans. There is enough options in the Indian markets. We've got 4,000 stocks, that's where we need to stick. Capital allocation, again, super important. We don't want leveraged companies. Leverage is okay, leverage is great, over leverage is not. At the end of it, debt, whoever is indebted to always stands higher on the cap table compared to shareholders. So if the company goes into liquidation, debt holders will get paid first, shareholders later. As an equity shareholder, I don't want that to happen. I want to ensure that debt equity is in place. I want to ensure that the company, whatever they're investing, they're earning much more in capital after that, and there is enough left for shareholders. Valuations we've covered. I think we're good. Move to the next one. Sorry, we'll just go back. I'll probably one more. The frameworks, I guess you can go to. Well, yeah. So this framework, I think, while we elaborated on stories and gave examples, I think I want to give you one last example, which is how we work in this framework and how we progress in it. The story is of a company called Deepak Nitrite. Deepak Nitrite is something that I invested in while I was at Taiwan 2018 at a price of 260 rupees, exited at 2000. Primarily, the story was very simple. Deepak Nitrite is a maker of very basic chemicals. They make sodium nitrite. They make this chemical called toluene. And then they had another division for performance chemicals. The story was that Deepak Nitrite realized that the Indian market is doing something very weird with a chemical called phenol. Now, phenol, very popular chemical. The annual demand for phenol in India was about 2 lakh tons at that time, in 2018. What was happening was that India was producing only 20 to 30,000 tons of that phenol. So only about 10 to 15%. The rest of the phenol that India was actually consuming was coming from China. Now, what is the raw material for phenol? There are two. There is benzene and there is propylene. Both of these are petrochemicals. India has enough production of benzene and propylene both. In fact, it had so much production of benzene and propylene that we were exporting those two chemicals. So Deepak Nitrite saw this opportunity. What they did was they put up a phenol plant themselves. They said, we'll buy the raw material from India, we will make phenol in India and we will sell in India. Why is this going to China, getting processed, coming back to India and selling at a higher price? Super inefficient. So import substitution, right? Deepak Nitrite, the ambitious guy, he put up a plant in Dahej of a capacity of 2 lakh tons. That was the annual demand of the entire country. So ambitious to an extent where they said, we are capturing the whole thing. Why even go for a little bit? Capture the whole thing. Now this was super sketchy for investors, right? You are like, how can you do that? Like, will a company be able to pull that off? It requires an investment of 1400 crores. What was Deepak Nitrite's annual revenue at that time? 1500 crores. What was their PAT? Profit after tax? 80 crores. So it was huge, it was ambitious, it was bold. If anybody invested at that price, that's when the market is completely discounting the story. They're not believing it. They're like, hey, this is not going to happen, not going to pull it off. But that's when the highest return is made, right? Invested in the company, you could say that, hey, let's not invest at this point, let's wait for some more evidence. And that's what actually we did. We waited for 2 quarters. They acquired the land already. We waited for 2 more quarters. Factory is almost done. They're saying 2 quarters down the line, we'll already start production. Within 2 years of announcing, they had started the factory and they were running at a 40% capacity utilization. Within 2.5 years, 100% capacity utilization. So if you look at Deepak Nitrite's financials from FY18 to FY20 or 21, you'll see the revenue tripling, triple revenue. Thanks to phenol capacity, they managed to grab the entire 2 lakh ton market. Today they are at a capacity of 3 lakh ton. They are investing more 1000 crores in the plant and they are going to reach about 6 lakh ton. So beautiful story in terms of capturing it. I'll admit here that I got a little bit lucky as well. What happened is that Deepak Nitrite has another division called specialty chemicals. So what they make is 2 chemicals there, OBA and DASDA. Both are brightening agents. They give the paper or detergent the whiteness that you see. That comes from these chemicals. What happened in China at that time was 2017, there was a massive environmental crackdown. 80,000 factories got shut. In that, all the producers of DASDA got shut overnight. Now there was a global supply crunch of DASDA. Deepak Nitrite was the only player at that time who could supply that kind of material, and DASDA prices shot up 4x within months. So DASDA, which was a loss-making entity for Deepak Nitrite in FY17, contributed to half the profit after tax in FY20. So we weren't lucky then, I'll have to admit. But the story, at least on the phenol side, played out. Now, whereas Deepak Nitrite, we are at a place where it has identified one more import substitution story. What they're doing is they're setting up plants for these 2 chemicals called MMA and PMMA. So these are chemicals and they're setting up a plant for polycarbonates as well. Polycarbonates are primarily used in electronics, semiconductors, chips, EVs, so all the sunrise industries. Again, imported entirely, and Deepak Nitrite is again going big, setting up big capacity in this. Plant may be operational in a couple of quarters. Can we see a repeat of what happened in the past? Probably not. Can we see a repeat in terms of lower quantum? Probably yes. And now they have proven capability. So I got the stock at 8 times forward P. Now it is trading at 25 times forward P. So from here, maybe valuation re-rating may not happen. But if they're able to double or triple their earnings in the next 2 to 3 years, I'm happy buying the stock for the earnings. So at the end of it, in the framework, do I have the story for Deepak Nitrate? Yes. Does it translate into earnings growth? Yes. Valuations? Probably not. From 25 times, I have to look at 2 things. Will there be valuation re-rating or de-rating? Am I confident that there will be no de-rating? Yes. Triggers, plant goes live in 2 quarters. Does it fit in my framework? Yes. Does the PMS have it? Yes. So that's where we land. I think I'll close here. That's our investment framework. Give you a few examples to not bore you, try to keep it interesting. And this is how we operate the PMS. This is how we pick up stocks. Thank you.
Please give an example of the site also.
Sorry.
I'm sure all books have been successful. Can you give
Great.
it?
I had one. I forgot that point. I genuinely forgot. So I have a failure example as well, where the story we were trying to play is Praj Industries. Now Praj Industries is a company which makes distillation equipment. Distillation equipment is involved. Distillation involved in any biological process. Right? So major customers for them are either ethanol makers or beer breweries. These are the 2 major equipment kinds that they have. The story we were trying to play out was that Nitin Gadkari was coming on TV every single day and saying that India will be 20% ethanol blended by 2 years or 3 years or whatever. And every year there was significant progress. We went from 10% ethanol blending to 16% in a matter of 1 year, which is a very large number. Suddenly there was news of Indigo launching a flight which was ATF blended with ethanol. So we're like, this is a good story to play out, right, at a country level. So we said, who is the major beneficiary here? We can play sugar companies, we can play Praj Industries. Sugar companies, no thank you. I mean, there is too much government intervention. Sugar prices are extremely volatile. So we said, let's play Praj because no matter what, at the end of it, Praj will win from this situation. And ethanol blending is not only popular in India, India is a follower. It's very popular even in the US, even in developed countries. So ethanol and Praj's 60% revenue comes from exports. So we're very happy to play this story. Then we went wrong because what happened is inflation struck us. And when inflation strikes, government tries to protect or tilt towards food security. For the government, people paying less for food, especially an essential commodity like sugar, is much more important compared to reducing pollution, for example, or reducing the cost of petrol. So priorities are very set for the government when it comes to these kind of situations. They immediately banned all sugar companies from diverting sugar production towards ethanol production. Overnight, the stock has fallen 20%. 2-3 days, I think we lost about 30% in the stock. We said, let's exit. Because we don't know when inflation will improve, we don't know when inflation will happen again, we don't know what the government does next. So we got out of that story on a timely basis.
What happened after that?
After that, again, we failed. So what happened is, a few months later, obviously, inflation came under control. And what's happened next is that sugar companies were again allowed to divert. MSPs for sugar are being spoken about to be re-leveled at a higher rate. Ethanol prices are good enough. So things are pretty much back to normal now, and Praj is doing extremely well. What has happened in the process also is the story has changed a little bit. Suddenly, India is one of the countries which is extremely dependent on sugar for ethanol making, which is not very typical in other countries. US, for example, gets a majority of their ethanol produced from corn, maize. So Praj is a company which is enabled or has equipment manufacturing ability not only for sugar but also corn, wheat, etc., etc. During this entire process where sugar companies had been barred from selling ethanol or making ethanol, there were multiple players setting up plants to make ethanol from maize and wheat and rice, not wheat, rice and maize. And the order book for Praj Industries has gotten pretty diversified now. So from majority of the orders coming from sugar, it is now pretty well diversified across all of these commodities. What's also happened is that they have started making ethanol. Ethanol also comes in types. There is a 1G, 2G, 3G, like you have a telecom. 1G ethanol is directly from sugarcane, you make ethanol. 2G is from the molasses or the broken, the residue, you make ethanol. 3G is from that residue, you again make ethanol. Right? So that process is also getting more efficient and stuff like that. Raj is doing very well again now. But we are still scared. We don't want more government intervention and risk for us, and hence we consciously stepped out of Raj. So as I said, if something's making you lose your sleep, is the money worth it? Probably not.
It's not deeper like that. They went to very high debt. How it fit into your investment framework because of the debt to equity going much higher, or how do you see that?
So Deepak Nitrite had not invested much for many years before that, so they had a decent cash balance. It wasn't a so the base chemicals, while there is no growth for the last 5 years before FY18, if you see the revenue is pretty steady, but the operating margins also steady. They're a good cash flow generating company, so they had a good cash balance. The 1400 crore that they were spending, they had a 40-60 debt to equity plan. So we knew that 40 to 60 is the plan. And we ran simple numbers, right? At the end of it, you know that 2 lakh tons is the capacity. If you assume that year 1 they hit 50% utilization, year 2 75, year 3 100, what is the price of ethanol? If they are producing that much, phenol, what is the price of phenol? How much are they producing? What is the capacity utilization? What will be the cash flow generation? And how much time will it take for Deepak Nitrite to repay the debt or bring the debt to equity down under control? And that math fit in pretty well. We were confident that if the numbers came true within 3 years, they would be able to control their debt equity levels. So if the plan is in place, then the capital allocation seems pretty appropriate. Do we have any other questions? Yes, sir.
The RBI reduced the rate of interest. Gold is going up, dollar is going up, and market is very volatile, going very low. Good time for investment.
So we think it's a great time for investing at this point. So,
My name is Chidambaram.
yeah,
I don't know nothing about market.
yeah.
You should start with me, so I came here. I don't have demat, I don't have trading. Okay?
Yeah.
Simple thing. Market alone going down. Understand? Economical factor. Like sun, moon, like sites.
Yeah.
Market is going down, all other products are going up. The 1 gram gold, 8,000 cars. Yesterday I visited PRT, Sathyanarayanan, not for purchase, for some other purpose. Because PRT share is going very well. The private limited, but some other business. No rush. For gold also no rush. The daily rate going up. Our market alone going down.
Yeah. So I'll just come back to a very basic fundamental where you buy low, sell high. Right? I personally wouldn't buy gold right now. Prasanna's of a different view. He's for gold. Will I buy equities? Yes. And it boils down to a couple of things. How convinced am I of the India story? If I look around, I know that within, say, from now to 5 years hence, will India's economy or will the progress around me remain steady? Will things around me be neutral? Will they go down or will they go up? My fair assessment and common intuition is that it will go up. If I know that directionally I'm in the right place, structurally I'm going in the right direction, it's never going to be a straight line. It's always going to have up, down, but the overall direction is going to be up. In that case, I will always try to buy the dip. And that's where we're at right now. So if the market has fallen 12%, if some stocks, mid caps have fallen 15-20%, some of the stocks I like, some of the stories I love have fallen 30-40%, I'm deploying cash right now. So to give you a simple example, in the PMS, despite us starting only 7 months back, we were about 30 to 40% on cash and gold 3 months back. over the last 3 months till date, we have deployed about 15 to 20% of that cash. We are still sitting on 5 to 10% cash, I'll admit that. But that is something we are very actively looking to deploy. So we have it's like we have a shopping list. And we see when the markets fall, we see a discount coupon. And we utilize our cash to avail that. That's how we're looking at it.
More question. Those days, 2005, 2008, 11, like that, so many fall, so many up. Now, at that time, there is no technical support, no software like this. Now, you are very young and you are handling so many portfolios. Now, so many factors are involved. Software, some AI technology, and the other what is called inputs like that. So, whether we give good result or average result or bad result.
Good, bad, or average result in the market?
Yes.
For me.
Because those days we have only buy at low, sell at high. Because of our experience. No technical, no AI, no software, no cryptocurrency or this and that like that. Now, in your age, you are having lot of factors, instruments, not only gold, silver, dollar like that. So my simple question is that all this AI technology or other software will spoil or this downward will get super support.
I think as information becomes more freely available and commoditized, we have to look for pockets which are not exploited. And that's where we've been saying that the unanimous, uniform direction that the markets have been taking so far will become increasingly divergent. It will become more of a game of expertise, whoever is good at picking stocks, understanding businesses. At the end of the day, when I go and sit in front of the CEO of Deepak Nitrite and understand his conviction from his mouth, I don't think AI can replace that. When I look at Infosys and when they had a bad CEO, and when Nandan Nilekani left the Aadhaar job, went back to Infosys to repair that, the trust I have in Nandan Nilekani doing that comes out of experience. I don't think AI can replace that. So I think there are still a lot of fundamental things that we run, that we do, that we encourage. Today we have boys, 23, 24-year-olds in our team for research analysis. They usually rely on these tools, right? You ask them a question, they chat GPT it and they give you an answer. And it shows. Immediately looking at it, we know what they've done, right? So I think that is going to be the differentiator. The easier things become, the more shallow research becomes. We are here for the deep stuff. So I think it's going to be a stock pickers market as long as you're picking up the right businesses and sticking around for the long term. I think there is immense wealth to be created irrespective of whether tools exist or not. The best way to go is probably use these tools to improve your efficiency, but not fully rely on them. That's our approach. So we mix the two.
We have PMSs which are going to have definitely exposure on
We've got 4,000 stocks in India. We've got a team of 10 people. I think there is enough happening in the Indian markets. Sorry? No, so what we've noticed is that we want to create very India-specific instruments at this point in time. I mean, I'm saying this right now, my view may change at a later point after assessing the market a little more, because we just about started, right? Our assessment is that people look at PMSs as one of the things that they have in their overall portfolio. It's not that they're giving you the entire portfolio and saying diversify this form. Somebody else is already taking care of the diversification at their level using mutual funds, using international equities, using real estate. So they're looking at our product as an instrument for wealth creation and wealth creation over the long term. So I don't think it's our job to diversify it to that level. We may diversify it within sectors, within companies, etc. So the mandate we are taking is that we will invest in equities. Sometimes we'll sit on cash, but that's for safety. That's not for diversification. So I don't think we're in that international space at the moment. I think there's enough to be explored in India, and our hands are pretty full with the India mix. So nothing on the cards right now, but I'm not going to rule that out.
I'll just add one point to that. As I mentioned, so when we are looking at an opportunity, the more of a certainty we pay for. So India is one market where we are looking at much of a certainty. Of course, others are on boosters. Okay,
They are on boosters. Whether it is China, which is looking cheap and all. But then the problem is there is no certainty. If you look at because a lot of debt, everything is up. There is no certainty. And the consistency and certainty where I am. So I am going to make better returns here. There are going to be pockets where the US is going to be doing good and India is not doing good. But when I look at the 5 years and 10 years story, I guess our domestic consumption, 140 crore people consuming that story plays a lot much better than other investment destinations. So that's why I guess right now we are where is looking at domestic story. That is what we are looking at.
There's one more thing that happened when I was at Daiwa is a global fund, right? Daiwa being a global fund, and I was doing pretty well tracking sectors like technology. That was my career in Motilal as well. So I was good at technology investments in India, which are mainly IT services companies, product companies, stuff like that. My fund manager from Singapore called me one day. He's like, "Go to Israel. They're doing good tech. So find investment opportunities in Israel." And I was lost. To be honest, I said before booking my tickets, I want to study the market a little bit, see what's available. Suddenly you're looking at drones, you're looking at AI, you're looking at stuff. I've been tracking Infosys for 20 quarters. Nothing happens in these companies that is extraordinary. Sure, stuff happens, they adapt and stuff like that, but cutting that stuff I don't understand. So all I'm trying to get at is that we have familiarity with the Indian markets, we understand the Indian consumer, we understand Indian businesses, we understand the competitive landscapes here. To be able to pick stocks abroad is going to be difficult. So I think if you ever do that, indexes are easier. Intuitively, I know I want to invest in FANG. I want to pick up the Max 7. I want to pick up the Taiwan semiconductor industry. I want to pick up KOSPI when it's lower. I want to pick up Euro 3 months back. I want to pick up Hang Seng right now. I want to do all of that. I can do all of that. So intuitively, I think I can take broad calls. Can I pick up a multi-bagger in the US? Probably not. That's going to be a tough one.
Gold prices have been consistently rising. Either stagnant or rising. So is it good to invest or not? Because we always have a controversy on that.
Gold, even we have a opposite view. I don't like it at this point, he does. So I'll let him take it.
Look, what we were looking for gold is like whenever there is a geopolitical concerns we have, gold is one safe haven we have. And since the day paper kind of gold, European started, America started, so that created a lot of opportunity and a lot of demand for that. So as a safe haven, yes, we like it. But again, you need to diversify your portfolio, okay? The way we did for last 6 to 7 months, and we have been outperforming, not outperforming, our decline has been low because we have good. Now, again, I started with one factor that predicting any level is a futile exercise. But then right opportunity, right price, right value I'm getting, and I'm getting that. I will put my 20% in gold and I'll be happy if I get that those returns. Putting 100% in gold, no, that's not an idea what I will follow. But yes, gold right now we like. Yes, he disagrees, but then there are calls we need to take, and diversification is one part which plays a lot of role in capital allocation and staying ahead of the curve. Okay, so gold prices is good. How long that will sustain? Again, anybody's guess.
All of us have, none of us have seen in history that gold has actually.
No, I will give you an example.
Or little bit down, but always it's been on the rise. Now, phenomenal increase in last few months.
So that's what I'm saying. We have seen in 2009-10 silver prices moving up to 76,000, coming all the way to 22,000. So that volatility is going to be there. But again, between certain gold wasn't there, but again it remains stagnant. It wasn't providing.
Gold has, I know gold going to go 3,100, coming back to 2,300.
USD terms, yes, possibly.
For last 3,100, and then it came down for 2,300. Somebody 2,011.
But not much. Now, what my question is, because it's always a controversy. Few months ago, it was 6,000, and he was saying, oh, it's already high because of the war, this, that, and he calmed down. Then it kept going up, it's now 8,000. We are not seeing how much will it increase? 10%,
behave that way. But again, how much exposure we need to have, that is call we need to take. That's the end call. Means I don't think that having heavy exposure just to any one commodities are very like I'll just say it's like girlfriend. You don't know what the mood will be. So right there you avoid commodities or either have legal. That is what we try to do. That's what answer I will. But again, that's a joke part. But yes, gold is one part we have sometimes in our portfolio and we try to get that. But completely on gold, I will try to avoid. That is what our call is.
Gold is not a
So-
investment product.
I'll try to give it that.
I will just add one part to that.
Just one, rather than predicting the price, I would play on how much weightage gold has in my portfolio. When it is at a low, I would be comfortable with 20% weight for gold. At this point in time, I'm not saying gold, I don't want to take a call whether it will rise or not. If the level is making me uncomfortable, I'll reduce my exposure to it. So I'll not play price, I'll play weight.
Basically, what I think is looking at where equity is and where gold is, wise to invest in equity.
I'm on the same page as you.
As he mentioned,
Gold is not an investment. Sorry, gold is not an investment. Look, in India, most of gold is physical gold. Okay. Someone if you try to sell your buy gold, you come back and I will do a good tip for rupees. So that's not an investment. I agree for that. Okay. E-gold, ETFs, that is investment. That is just starting. So I guess as an investment part, we are at the national stage. Yes, we have a lot of gold reserves, but not in actual markets as a savings part.
that's what I am always against physical gold. So against having physical gold, then we could have e-gold.
Do you feel that national reserves which are being restored?
I guess that's a long topic. We can have that discussion one to one. Because what happens? Yes, sorry.
Yeah, I'm Balu from Madras Boat Club. I just wanted about the potential for the PMS because we are an MFB. So what is the current AUM of the PMS? And we have 43 AMCs. How many PMS companies or PMS companies operate in India? And what is the growth? I could see some data of SBI. SBI is currently, I think, in terms of MF, they have got 12 lakh crores. But when it comes to PMS, they have got 14 lakh crores. I'm not sure whether the data is right or wrong. What is the growth of PMS in India? Currently, MF size is 60 lakhs. So can you just give some insight on that so that as a distributor we can get prepared for the future?
Yeah, so MF is about 60, PMS would be about 20 or 22 lakh, somewhere around that number, ballpark, take it at a plus minus 10-15%. However, I think the difference is that you've got 40 AMCs, about 400 PMSs. Yeah, 400, but out of that, about 50 to 70 are people who are not really worried about their license, they're not even complying to regulation. Quarterly disclosure, annual disclosure not happening, they're just lying there defunct. Several of the others, there is a very, there's a glass ceiling at 100 crores. Not many are able to cross that 100 crores. So there is a very long tail. So the top 10 PMSs would have captured probably 90% of the market in terms of AUM. However, the way we look at it is that the top guys who are managing that kind of money, they start getting, the purpose of a PMS starts getting defeated. Because a PMS is supposed to be a customized product. It's supposed to be tailor-made. It's supposed to be personalized because everybody is investing at a different time. So if I am buying a multi-bagger, for example, I have bought it in Mr. Pramod's portfolio at say 100 rupees. You come in as an investor when the stock is 200. I'm not going to give it the same weight. Probably I'll not even invest in that stock. So what happens is because of the timing of investment, each portfolio is going to differ. SEBI regulation also says that the PMS should not take the character of a fund. It should be a strategy. It should be a tailor-made solution. It should not take the character of a fund. If I look at the top 10 PMSs, they are characters of a fund. They invest, they have model portfolios. So what I believe is that there are going to be two things happening. One is that model portfolios people will invest in as long as they show significant outperformance compared to mutual funds. Right? Number two, people with very highly customization requirements will always opt for boutique PMSs to take care of their portfolios. I think there is opportunity for both of these. Why model portfolios? Because mutual funds have a lot of regulation. You end up with 80 to 100 stocks in a mutual fund. There are caps in terms of if you're a large cap mutual fund, 65% has to be large cap. If you're a mid cap, it has to be this much. If you're a sector based, 80% has to be this much. So there are a lot of caps. No stock can be exceeding 5%, no conglomerate, whatever. There's too many regulations. The more limitations you put on a fund manager, the worse his performance will be. That's because you're literally choking, you're not giving me any room to move. Sometimes as an aggressive fund manager, I want to take a bold call. If I'm very confident of an investment, I want to go all in. But I don't want to keep cutting my stock. If it's going to be a 10 bagger for me, I invest 5% in it. Very soon it's going to become 10% of my portfolio. Regulation tells me to keep cutting at that 10%. So I will never make a multi-bagger return out of it unless I am in a PMS. That's why some of the long-term PMSs like Equitas, like Unveiling, like a lot of these very healthy, good competitors, if you look at their 5-10-year returns, they produce magnificent returns. So I think there is a very strong market for model portfolios which are meant for the long term, which take concentrated bets. And despite the taxation issues, etc., I think PMS is a very good option for that market. For the personalized market, again, what happens is there is you either go with an advisor or you go with a PMS. And I think there is also a very large growing 1% of our country. Right? India, despite whatever we say about development, it is not a very inclusive development. It is a very polarized market. The rich keep getting richer, the poor sort of keep lingering around it. So from that angle, I think PMS again is a great market because we don't have hedge funds. The only alternatives to hedge funds in India are PMSs and AIFs. So from that angle, if your call is that the rich will keep getting richer and they will keep needing relationship managers to come to their house and give them special services, the PMS industry is bound for much higher growth compared to mutual funds in the future. Even if you look at redemptions, for example, right now, I haven't seen the data, but in personal experience, I run two products. I run small cases and I run PMS. Right? Small cases, the average investor size is about 3 lakh rupees. I have seen my investor base go down 20% in the last 4 months in small cases. PMS is 50 lakh.
Okay.
This is small case. This is the online product.
Okay.
Separate product, advisory product. PMS, we've been seeing top-ups from investors. So it's a very mature kind of investor. It is a much healthier investor. And I am tempted to say that why am I doing small case? Why am I dealing with the retail investor today? If I have a non-headache, easy life with a rich guy who understands that when the markets are falling, you have to double up your investment, give me the money.
If somebody is investing today, how long you take to deploy? That's the first question. And second, in terms of allocation, large, mid, and small, how it will be today, or in general, what would be the allocation?
So in terms of time to deploy, it varies depending on the market condition.
I'm back to
Today, I would deploy 85% of equities, I would keep 15% cash. That's what we're doing consciously in all the funds. In terms of strategies, we've got, and Satya sir is going to present next, he'll cover a little bit on what strategies we have. We have 3 market cap based strategies. One is the flagship fund, which is the Southern Spice fund. We've got 3 market cap oriented strategies. One is the large and mid cap, one is mid and small, and the other is small. Unlike mutual funds, like I mentioned, we don't have the limitation and regulation or heavy regulatory oversight on us. So what we tend to do is it gives us room and flexibility. So in the mid and small cap fund right now, for example, we're sitting at 30% large caps. That gives us the ability to live in some comfort, ride the bottom out, 30% cash, 30% large caps, and only invested 60% in, 40% mid and small. Mid and small, the bloodbath that has happened, we've not faced it because of this. So we're able to protect capital when it is required. However, situation normalizes, we will go back to the fund being 100% mid and small cap. So we're deploying flexibility wherever we get the chance to, because that's how we can protect our clients' money and actually to give it much more deserving treatment. And we will change strategies when the time comes.
What would be the ideal number? 20 stocks or 30 stocks?
20 to 25 is what we do usually. Right now, some of these schemes will have more than 25, but that's only because our call is that we want to diversify at this point in time to protect capital. Our call is that because the markets are falling, we want a wider spread. We are more comfortable with concentrated bets when it is a rising market, not when it is a falling market. So during the rising market, I think we'll be between 15 and 20. In a falling market, between 25 and 30. Beyond that, never, because might as well take an index fund and sit on it.
So what's the minimum market cap you can consider? Say for example, in a small cap fund, most of them are minimum 1,000 crores
Yeah.
and above. Some are 5,000 and above. So in your case, is the minimum maybe 100 crores, 200 crores, or even if you like something, 50 crores also you will take it.
No, so the funder that we put in is that if we have to buy, say for example, our AUM is 100 crores, we are buying a certain stock to the extent of 5% in all portfolios. So if we pick up 5 crore of that particular stock, we should be able to pick up our entire 5 crore position in a matter of 5 trading days with our volume on any single day not exceeding 20% of the total traded value of that day. If we are able to do that, we will pick up the stock, otherwise that's out. Because that will have an impact cost not only on entry but also on exit. So if stuff goes down tomorrow, then I want to exit without an impact cost as well. So we don't have a market cap criteria, we have a liquidity criteria.
But actually, it also
It translates into a certain market cap, yeah. But I think
I'm talking roughly.
1,000 is, I think, 1,000 is a pair, like, we don't go there. I think
What happens is like you take top 700 companies and you get good opportunities of mid cap and small cap in that. But around 1,000 crore is what we to a broad list.
What we do here is we have a presentation on the Southern Fund as well, which is our flagship product. I'll let Mr. Satya take over and present that. We bounce back to Q&A after that session is done. And of course, we've got dinner and drinks after, so we've got all the time to catch up at that time as well. So I'll let Satya sir take over from here, and then we'll come back. Yeah. Thank you.
A very quick introduction about Mr. Sathyanarayanan, CEO, Paterson Securities Private Limited. Mr. Satya is a seasoned professional with over 30 years of experience in marketing, financial products and services. From leading large teams to driving substantial growth in key regions, his ability to expand business operations and cultivate strong relationships within the industry is truly impressive. Mr. Sathyanarayanan has been instrumental in shaping the financial landscape with a proven track record in building successful strategies and delivering exceptional results across various markets.
Thank you, Dashni. Very tough when I saw what was holding you always waiting for the presentation to finish, right? Yeah. The topic Southern Spice. Again, spices are at the back. The name itself says that something distinctive about South India. If you see, not only in politics, in films, in our day-to-day consumption patterns, and the way of life where we are leading, and the cultural character that exists in the normal 4 southern states. And the same applies to the South Indian businesses also. Normally, if you could see the South Indian businesses, they are more conservative. They are not very aggressive. They are very law compliant. And they will look at only opportunistic assets, and they will never leverage their balance sheets or liabilities. And thereby, they will provide growth, dividends and performance. And a typical feature of such businesses leading to high earnings, visibility. Such companies provide the necessary defensive anchor to one's portfolio. And that is the main thing of this Southern Spice. So normally Prasanna has been dealing with India growth. These are the key factors which we have been seeing on the last decade. You could see the highways, it was 79,000 kilometers down the line in 2012. Now it has been 140,000 kilometers. And internet usage on households, it is considerably increased. And the domestic travel, see, thanks to the young generation entrepreneurs and the business people and the new employees who are taking business trips as well as travel trips in and around India. And going to the bank accounts which has been considerably rising. Coming to the north and south divide, I don't know why it is a divide, but the difference is there. Before going into this per capita, let me give you some interesting statistics about southern states. If you could see the GSDP output, Tamil Nadu leads the stock with a gross domestic product of 24.8 trillion approximately, which is followed by Karnataka, which is having 22.4 billion of GSDP. Then Telangana at 13.3 million, with Kerala and Andhra Pradesh at 13.2 and 10 million respectively. Tamil Nadu is expected to grow at 14% with this current state budget at 28.3 trillion according to the current state budget. So coming to the next statistic. The state tax revenue, again Tamil Nadu is leading in terms of revenue collected at 1.26 trillion, and which is followed by Karnataka closely at 1.11 trillion, then Telangana at 929.1 billion, and the fourth and fifth positions are with Andhra and Kerala. So now coming to the per capita income, yes, Telangana has reported the highest per capita income in the region with INR of 2,75,443 approximately, followed by Karnataka at 2,65,823. Third is Tamil Nadu at 2,41,131 and Kerala at the fourth spot. Coming to the per capita income of the southern states, which has been grown at 10% CAGR. And southern states are always ahead of the northern states in terms of per capita income. The reason is southern states have more per capita income, more literacy level, and more wealth creation other than the northern counterparts. So South India is seen emerging as one of the most lucrative investment destinations across India. Leading the charge, boasting strong agriculture, manufacturing and service sectors, these states offer a plethora of investments opportunities to multinational firms which want to expand their presence in India. The opportunities range from production and sourcing to research, development, R&D, besides agriculture and allied activities. Local supply chains as well as developed in these states compete for foreign investments in both mature sectors like electronics, textile, apparel, automotive manufacturing, IT, software and other enabled services as well as EVs, genomics, pharmaceuticals and top startups like Bangalore, Karnataka, Hyderabad and Chennai. Another key factor that makes South India an attractive investment destination is robust logistics infrastructure. The coastal states in particular benefit from easy access to ports, making it easier to transport goods both domestically and internationally. This, coupled with the presence of skilled labor and reputed higher education and R&D firms, makes South India a sought-after regional destination for businesses in the manufacturing and the service sectors. In terms of local business ecosystems, South Indian firms are considered to be conservative. These businesses view their operations as a long-term ventures rather than short-term opportunities exploited. They tend to avoid excessive borrowings and are committed to the following law. Additionally, these companies typically keep a low profile. Such businesses are known as their consistent growth, performance, and dividends, which results in a greater earning predictability. See, why there's a huge business differences between the north and south is what mainly contemplated actually. India is fragmented. If you could see, the regional differences like language, the culture, the infrastructure, the wealth distribution, which influence the Indian society, therefore never be compared to individual countries. India is the most populous state. Uttar Pradesh has the same number of inhabitants as Brazil, and southern state of Tamil Nadu has an economy as large as that of Hungary. See, normally what is not as an aggression and risk-taking and are being tampered with caution and new work ethic, but south is the moderate approach and an emphasis on core competency are giving way to a wider perspective. So why do we select southern companies? It's just an example which we have taken. Our 1 lakh invested 10 years ago, and there's an CAGR which has been taken. So the investment of 1 lakh in cube investments would have given you 13,40,000 rupees as of now, the wealth created. The same is in the case of MM and Bidkar, and the top where is TVS Motors with 32,21,000 of wealth which is being created, followed by Sudam Finance. So what we have done so far as a Paterson has been serving a lot of promoters and their companies over a period of 100 years. There are a lot of companies have their holdings with us. They have kept their confidence in us, and Paterson has successfully increased or executed innumerable investment banking deals and institutional deals for the service-based companies. So this is mainly due to our relationship which we have been maintaining so far with our clients as well as the promoters. So what is the main agenda of the Paterson Spices? Long-term wealth creation. Our approach is focused and it's a thematic fund. Okay? The stocks which we are going to select is ranging from 10 to 30 numbers. The benchmarking will be on 5,500 and the investment amount is 50 lakhs. So the composition of our fund is on consumer durables it is 8%, on technology it is 10%, on auto and auto ancillaries it is 18%, on financial services is 25%, on healthcare industries 20%, materials 8%, and defense is 6%, and engineering 10%. And cash 8% is the buffer for us, which we are.
Not investing fully, that's why we have kept that.
That's the thing. So the investment in caps. So the mid caps is 30%, large cap is 44%, 22% and small caps is 18%. So the fund comparison, somebody has asked for the fund comparison of the different schemes which we are having. So for Southern, we are having this 50% in large cap and 25% in mid cap and 25% in small cap. For Advantage, it is 50 in large and 50 in mid. For Delta, it is 50 in mid and 50 in small. And Leadership, it is 25 in large cap, 25 in small cap, and 25 in mid cap and 50 in small cap. So, our fund managers have recommended this 2 stocks. That actually there are 16 stocks in our fund as it has been selected. But more specifically, these 2 stocks are in the radar of our fund managers. One is the Madras Labs. The thing is, the Madras Lab is, it has been high growth. The product is APs is selected high growth therapeutic areas and a major focus on anti-retroviral and cardiovascular diabetes and oncology drugs production. I will quickly run through the triggers. Madras Lab has 90 active projects, including human and animal health. Healthy order intake, continuing positive trend in third quarter of 25. The company's CDMO segment showing strong year-on-year growth with continued expansion and likely to boost profitability. The concerns are the US foreign suspension may disrupt the ARV supply. The low oncology API contribution reflects Q-on-Q ownership showing sales fluctuation based on the demand. The company's net debt and EBITDA ratio has been increased from 3x from 1.3x last year. The next counter is Zen Technologies. The products are training simulators, combat tactical weapons, an anti-drone system, and smart firing ranges, and live and virtual simulation systems. These are the products which are given to the defense sectors as such. The main triggers for the company are the company is expanding aggressively into the lucrative US defense market. It was 1,000 crore funding to drive the growth and enable acquisitions. Entry driven into Navy and air armed forces. The other thing is high demand. The main downside trigger is high dependence on the government orders and increased revenue unpredictability. And there is a slow growth in order book as such. So, with this I come to the end of Southern's Vice.
We can open up for a brief Q&A if there are any questions left. Otherwise, we'll obviously chat over more casual.
See, in PMS always, the opportunity cost is always being considered. With the increase in taxation, so how much you will also factor that? Because that is not being factored in the industry as such, even the bigger players. So that is having a huge impact, both the short-term capital gains also being increased. So, can you please throw light on how do you construct this portfolio and how much it will have an impact on the client portfolio, even though it is positioned for?
Yeah. So typically I'll tell you how we function in terms of our holding periods. Whenever we're not fond of churn, we don't like shuffling in and out of things on a daily, weekly basis. Unless we've either gone wrong in something or we've gone extremely right. To say that if you are expecting a stock to give us 30% return in 1 year, but it's given that 30% return in a month, or we've gone wrong, that's when we actually change our position. So our typical holding period has been 3 to 4 years, and hence the churn in our portfolio has been about 25% on an annual basis. That's the churn we've historically seen as a team functioning together for the last 4 years. And because of that, what happens is that most of your tax is long term. It is not short term in nature. We also come from the perspective that at the end of the day, we are different compared to the mutual fund industry in one major aspect which is tax. Transactions for mutual funds are not taxed. Capital gains are taxed in the hands of the investor whenever they redeem units. For us, it is not like that. For PMS, every transaction is a capital gains liability on the investor. And we understand that. We understand that business. The only way we also understand the PMS will work is if we are able to materially not just outperform mutual benchmarks, but also outperform mutual funds. That's when anybody has a reason to take that kind of risk and invest 50 lakh with one party like Madras. Given that understanding, I think we are very cost conscious and conscious about tax at each point in time. So we don't pick up short-term stuff. We don't pick up stuff that is meant for a few weeks or months. Our holding period is naturally tended towards the right long run. The other thing which is an advantage which we are able to utilize in the PMS, very less spoken about, is tax loss harvesting. What we can do is towards March 31st, if we've got 20 stocks in clients' portfolios, 5 are currently loss making, we can actually book losses in those at 31st March, buy them back on the 1st of April, and reduce the overall tax liability for the client, not only for this product but on their overall capital gains. So we get some amount of advantage over there as well. At the end of it, our goal is to deliver significantly higher returns on a net basis, not on a gross basis. Just the entire team being very, very conscious of that helps us in making sure that if the benchmark is delivering 15% and we are charging 2% fee, and the tax liability is going to add another percentage, for example, we want to deliver at least 5% more than that to clients. So just having that uniformity and understanding in the team entirely and being very clear and communicative about it with the clients is something that we take care of. Other than the small measures like tax loss harvesting and whatever.
What about the brokerage for the distributor? This is training.
Sorry.
Brokerage for us, for the PMS.
Oh, for the distributors. So what we're doing is there is a 2.5% fee for investors if they come in through distributors. It is a flat 2.5% fee. There is no profit sharing that we indulge in at this point in time. Of the 2.5%, we share out 1.5% for distributors, which is, I think, pretty much industry on the higher side actually in the industry standard. So 1.5 for distributors, we keep 1%.
First price, what is the typical figures of stocks?
Typical what stock?
The stocks.
I didn't get it. Typical? The universe. So the way we filter it down is that we see which companies are headquartered in south of India. That's one. Second, we can even pick up companies which have majority operations in South India or are focused on the South Indian market. Right? So that is the base level criteria in terms of how the universe is done. And then there are criteria applied in terms of market cap, in terms of some companies which are bad on corporate governance you want to leave out entirely, and stuff like that. And then we boil down to a list of about 500 companies. So the short list is about 500 companies, and obviously then from there, stock selection happens more bottom up because we are sort of very ingrained in the market. We know what is happening, who's doing what are the stories playing on. So universe of 500 stocks, and we not even 500 actually, I would say about 300. So 300 is the universe we play within that.
Because I have mentioned that 1,000 crore is cap we had today. So there were around 339 or 340 companies coming to that criteria. From that we had selected. That's what we do.
In our case, the PMS house have more schemes. Okay. So for example, that 50 lakhs can be divided into 3 or 4. So in your case, is it possible or we have to give 50 lakhs each and everything? We can choose either one and we have to give.
We are doing 50 lakh per scheme. So from a regulatory perspective, that can be interpreted in multiple ways. But we stick to the more conservative interpretation, and we say that if somebody is investing 50 lakh per scheme, it has to be 50 lakh. We don't divide it up into 2 schemes and say we don't do that.
person will have a very good experience, the other person will have a okay kind of experience, another person can have a bad experience also possible as far as I heard. So how do you manage this now? Overall experience is good.
Yeah, so I think the way to do it is one, not grow too big too fast. The moment you do that, you lose control of the personalization. And I think what we spoke about in terms of the two approaches PMSs can take, one is a model portfolio approach, where the scope of this disappointment is fairly large. And the other is a more customized approach where larger teams of fund managers and analysts are actively looking at portfolios before deciding. So they're not running a model portfolio. I realized this much later that fund management and portfolio management are very different things. They're used interchangeably, but they're very different things. I was a fund manager. I thought I was great. I became a portfolio manager. I had a lot of challenges. It's a learning curve, but as long as we're cognizant of putting the client first and not our ease first, I think we do a good job. So what we try to do is, number one, play with weights. So if something has gone up dramatically, I will reduce the weight in the new portfolio. If something has gone down, I'll probably be opportunistic and even double down on that weight at that point in time. Sometimes I'll just pick an alternate stock. I'll give you a great example. We spoke about PG Electroplast and the rate story that is. At a point I was uncomfortable with investing any more in PG Electroplast in the new clients that were coming in. We picked up a company called Impact Durables. Very similar business. They're doing the same thing. It's actually, while we say PG Electroplast is a Dixon in making, we say Impact is a PG in making. So we take an alternate. And as a fund house, I think since we've got a team of about 8 to 10 people in research and investments, we are invested in about 60-70 stocks. There is a lot under our radar at all times. So we have enough flexibility to say that if this is not available, we'll pick up something else. And that something else will not be a compromise. It will be something with an equally large opportunity and a promising probability of it generating similar returns as what we've missed on.
I will just add one point to that, sir. Like, what happens with our few figures, like, if you look at
I think many are.
So, thing is, if I look at top 100 companies by market cap, the average decline, from last 3 months is 24%. But if you look at the index, it has not fallen that much. Similarly, 250 companies, 100 to 250 is like 29% average decline. And it's 250 to 500 is like 35%. But then indexes are not showing that. Why? Because there is a weight management. Similarly, when I know certain company is doing well, and that weight management is what gives me an edge. And we had few funds coming in July. It was the right rate to calculate it. We got funds in October, but then weight management has helped me out to manage almost 100 basis point or 50 basis point return difference would be there, but then weight management is what we focus on. That one strategy I will discuss.
So we can either do that using more people or using tech. I think we're deploying both. So we've got enough tech to even give us a one-panel view of all the portfolios, so we're able to very well manage all this. I think let's continue this conversation over dinner and drinks. We'll see you on the other side. Thank you so much. Thank you.
From our old auction and very
Yes, we are now.
only now we
we have started brand Mari but it's over we are making this. Coffee is Karnataka. But we are now looking at the steel. Coffee is we have a okay. No, otherwise we can look